Possible net cash flows of projects A and B at the end of the first year, and their probabilities are given as below. Discount rate is 10%. For both the project, initial investment is rupees 10,000. From the following information, calculate the expected net present value for each project. State which project is preferable. So as you can observe in the table, they have given us two projects, project A and project B. Different events are given. Based on the event, what shall be the cash flow is given and the probability are given. Similarly, it has been given for project B. Question is to calculate the net present value. They are also saying that for both the projects, the initial investment is rupees 10,000. Initial investment, we can understand that as the present value of the cash outflow. Discount rate is also given. They are saying it is 10%. Now, normally they will give us what will be the life of the project. If I will do project A, then for how many years will these cash flows be generated? They haven't given us the number of years. So we will have to assume that it will be only for 1 year. Right. As such, also in the first line, they are saying that possible net cash flows of project A and B at the end of first year. That's it. So it seems to be a 1 year project. So what we will do is whatever cash flows that they have given, we will multiply with their corresponding probabilities and take a total. That will give you expected CFAT. Okay, that will give us expected cash flow after tax, or simply expected cash flow. You can even call it as bar CFAT. Okay, that's a statistical way of writing that it is an expected cash flow after tax. We shall discount that and work out the present value. Since it's only a 1 year project, that will give us the sigma PVCI. From that, we will deduct the sigma PVCO. We will get the net present value. So let's work it out. Calculation of expected NPV. Whenever we are using probabilities, we will use the word expected. Okay. Just see the way I'm planning to solve this question. We'll say here our discount rate is 10%. It is common, so I am writing it here. And then I say project A. We'll say cash flow probability expected cash flow and then the present value. Right, all this is for project A. Similarly, project B, cash flow, the probability, expected cash flow, and the present value. That's for project B. Project is only for 1 year. 10% present value factor will be 0.909, right? And the cash flows that we are getting are 8,000, 10,000, 12,000, 14,000, and 16,000. Probability is 0.1, 0.2, 0.4, 0.2, 0.1. Similarly, we have 24,000, 20,000, 16,000, 12,000, and 8,000. Probability is 0.1, 0.15, 0.50, again 0.15 and 0.10. Okay, now the expected cash flow. The way you are going to work out the expected cash flow, what you should do is in your calculator, you should multiply 8,000 into zero point 0.1. Do it, 8,000 into zero point 0.1 and press the M plus key, right? You have that memory key, isn't it? So press M plus. Then 10,000 into zero point 0.2, press M plus. 12,000 into zero point 0.4, press M plus. 14,000 into zero point 0.2, M plus. 16,000 into zero point 0.1, M plus. And then press memory recall. Your expected cash flow is turning out to be 12,000. And then discount it at 0.909. So I get 10,908. Okay, I get 10,908. So sigma PVCI is 10,908 less present value of the cash outflow. The project is costing you 10,000. The difference is 908. This is expected NPV. You can also call this as bar NPV, right? Expected cash flow, you can say as bar cash flow, similarly bar NPV over here. Okay, so similarly do it for the other project. What do you say? 24,000 into zero point 0.1, 20,000 into 0.15, 16,000 into 0.5, 12,000 into 0.15, and 8,000 into 0.10. And then take a total and work out the expected cash flow. Okay, expected cash flow. It's turning out to be 16,000 over here. Discount at 10% first year, 0.909. I get 14,544. This project is also costing 10,000. So we get an NPV of 4544. Net present value of 4544. They are not asking us whether which project should be accepted. But in case if they'd asked that question that which project should be accepted, you should accept project B because project B has higher net present value.